Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
Today we're sharing three stories. First, a wild deal where Nvidia and AMD will reportedly pay the White House a 15% cut on China sales of H20 chips, a move that came after a meeting between CEO Jensen Huang and Donald Trump. Then we're digging into the Reserve Bank of Australia, where a new board structure has left the governor in the minority, forcing traders to use advanced AI to predict the secret votes of its powerful, unknown members. And finally, Donald Trump's 100% tariff threat is rattling the semiconductor world. But the real story is how SK Hynix is creating custom HBM4 chips to lock in Nvidia, while its rival Samsung fears a massive oversupply. The most unexpected news in the finance world today has to be this. Two of the world's biggest tech rivals, Nvidia and Advanced Micro Devices, have reportedly agreed to give the US government a direct cut of their profits. In an unprecedented arrangement, the chip giants will pay 15% of their revenues from certain chip sales in China directly to the White House. This isn't a tax, it's a direct revenue share. To put this in perspective, historically, the US government has used taxes on imports to regulate trade. In fact, for over a century, tariffs made up the vast majority of federal income. But a direct revenue share on exports, that's a fundamental shift in how the government can interact with private industry on the global stage. What some are calling a tariff as royalty that lacks any clear legal precedent in modern US trade policy. In exchange, they get the golden ticket, highly sought-after licenses to export their powerful H20 and MI308 chips into the massive Chinese market. So the thing is, those chips, the H20 and MI308, are not the company's top-of-the-line products. They are specifically designed for compliance. To put it simply, they're intentionally nerfed or downgraded to meet US export controls. For example, Nvidia's flagship H100 chip is a beast, but the H20 version sold to China has its core computing power slashed by over 80% to fall below performance thresholds. They're powerful, but just weak enough to be legal. This move doesn't come out of nowhere. It lands just after a threat was issued to implement a 100% tariff on all semiconductor imports from companies not building facilities in the United States. 100%, a potential death sentence for complex global supply chains. What really brought this to a head was the report of this 15% deal following a meeting between Nvidia CEO Jensen Huang and Donald Trump. While Nvidia's official statement is simply that they follow the rules, the optics are impossible to ignore. Research shows this deal was a result of intensive lobbying, with multiple meetings taking place to find a compromise, a backroom deal to avoid a public war, or a new playbook for American industrial policy. This arrangement carves out a special exception for two of the most important companies in the world, allowing them to navigate a trade environment that is shutting down others. And here's where it gets interesting. This deal effectively grants Nvidia and AMD privileged access, creating what some analysts are calling a government-sanctioned duopoly for the China market. It raises serious questions for competitors like Intel or smaller AI hardware startups. Are they being offered similar deals, or are they being locked out? It all begs the ultimate question. Is this a one-time deal born of extreme circumstances? Or have we just witnessed the blueprint for the future of global trade, where corporate access to foreign markets comes with a direct price tag, payable straight to the government? And while the deal brings revenue back to the US, experts are debating a critical risk by allowing the sale of these good enough chips is the US, undermining its own long-term strategy to slow China's technological progress for a short-term payday. And which industry is next? Speaking of governments making unpredictable moves that rattle markets, let's head over to Australia, where the central bank just pulled the rug out from under investors, signaling a massive power shift happening behind closed doors. It all started when markets and 31 out of 37 economists in a Reuters poll were heavily betting on an interest rate cut in July. The Reserve Bank of Australia did nothing to push back, encouraging investors to pile in. Then came the shock decision. In a rare 6-3 split vote, the bank held rates steady, leaving many with painful losses. This radical change wasn't random. It came from a major independent review in 2023 that recommended a new board structure. The goal was to break up potential groupthink inside the central bank by bringing in outside experts from business and labour markets. The idea is that These diverse perspectives could lead to more balanced decisions, but believe it or not, it also makes Australia a global outlier in how it runs its monetary policy. The RBA itself is now a minority on its new 9-member monetary policy board, with only 2 officials against 6 external members whose views are almost completely unknown. After all, this creates a huge accountability problem. These external members now wield immense economic power, but their individual votes and reasoning remain secret. The International Monetary Fund stresses that transparency is critical for a central bank's public trust. Without it, how can markets or the public hold these powerful new figures accountable? Interestingly enough, while the public is left in the dark, a new high-tech battle is unfolding behind the scenes. High-frequency and algorithmic trading firms are treating this new board like a black box. They're deploying advanced AI using natural language processing to scan every word of past speeches, and even analysing social media sentiment to build psychological profiles of these unknown members, all in an attempt to predict how they'll vote. This means the RBA governor can no longer offer clear guidance to the markets. According to one former top official, the board is now emboldened to disagree with the governor. It's now entirely possible the head of the central bank could be outvoted on interest rates, yet still have to front the media and defend a decision they personally opposed. You can just imagine the closed-door meetings, external members with their own business backgrounds, bringing private data that directly challenges the central bank's official economic models. This creates a situation of dueling datasets. And this new dynamic effectively breaks the most powerful tool for calming markets, forward guidance. That's when a central bank governor clearly signals future policy. But how can the governor give guidance if they can be overruled? This isn't just an Australian problem. Central banks like the US Federal Reserve have also struggled to make their guidance credible, leading to market confusion and volatility. Another former assistant governor put it bluntly, markets will be surprised more often in Australia than in other major economies. Even the RBA's deputy governor conceded the last decision was less predictable than it should have been, admitting the board is still feeling our way and warning there will be shocks from time to time. Now, investors are once again convinced a rate cut is coming at the next meeting on August 12th, hoping the board won't want to deliver a shock twice in a row. In this new era of high-stakes unpredictability, is that a safe bet or just another costly mistake waiting to happen? From one high-stakes gamble to another, the United States is now threatening a 100% tariff on semiconductor chips. That's the bombshell statement from US. President Donald Trump, who said the new tariff would apply to all chips coming into the country from firms not manufacturing in America. The announcement sent immediate shockwaves through the global tech supply chain, and a key vulnerability isn't just where the chips are initially made. A huge bottleneck is in something called advanced packaging. Many of these complex AI chips, after being fabricated, have to be sent to Taiwan, where companies like TSMC perform the incredibly difficult task of stacking the memory layers together. That concentration of a critical step in one geographic location creates immense geopolitical risk. A single disruption there could halt the entire AI industry. But in a high-stakes geopolitical maneuver, South Korea's top trade envoy says its 2 giants, Samsung and SK Hynix, will not be subject to the tariffs. The reason? Their massive manufacturing investments on US soil, from Texas to Indiana. This tariff battle is unfolding over a market that is exploding. SK Hynix just dropped a forecast that has Wall Street buzzing. The company projects the market for specialized AI memory chips will grow an astonishing 30% every single year until 2030, swelling into a market worth tens of billions of dollars. And some experts believe that forecast is actually conservative. Why? Because it accounts for a major bottleneck that has nothing to do with technology or money. I'm talking about energy. The data centers needed to run AI are consuming power at the rate of small cities. Projections show that by 2030, data centers could consume nearly 10% of all electricity in the United States. We are rapidly approaching a point where the growth of AI could be limited not by our ability to make chips, but by our ability to simply plug them in. This is where the situation takes a more complex turn. The game has completely changed. An SK Hynix executive revealed that these high bandwidth memory chips are no longer commodities. They are now custom built for specific clients like Nvidia, meaning a competitor can't just swap in their own product. This strategic shift is designed to lock in customers and lock out rivals. These new chips, known as HBM4, will include a customer-specific logic die. Think of it like a key cut for a specific lock. The memory is physically and logically tailored to work with one client's processor and no one else's. This creates what the industry calls vendor lock-in, giving a company like SK Hynix immense pricing power, and it creates a dangerous two-tier system. Big tech gets the hyper-optimized custom chips, while startups and smaller players are left with a generic one-size-fits-all product. This hardware gap could entrench the dominance of today's giants and make it much harder for the next great idea to even get off the ground. This creates a massive power struggle. While SK Hynix is forecasting a decade-long boom, its chief rival Samsung is sounding the alarm, cautioning that chip supply could soon outpace demand, putting serious pressure on prices. When we place SK Hynix's current success alongside Samsung's reported challenges, the contradiction becomes clear. Their views are shaped by their current reality. SK Hynix is riding high, holding a dominant market share and enjoying a massive surge in profits thanks to its strong partnership with Nvidia. They literally can't make chips fast enough. Samsung, on the other hand, has reportedly faced production challenges and delays in getting its most advanced chips approved by top-tier clients. So, from their perspective, the market looks much tougher, and they see a real risk of oversupply as everyone rushes to build more capacity. So, who's right? Is this the start of an unstoppable, custom-built AI gold rush, or is a battle over price and oversupply about to begin? One thing is certain, in the high-stakes world of AI chips, the fight for dominance is just getting started.
That's it for today on Voce Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.